Hi, my name is Ryan, the Frugal Analyst, and I'm going to show you how I invest, my thinking behind it, and where I'm putting my $1 million portfolio. My investing strategy evolved over time. I read investment books, talked to investment professionals, talked to people smarter than I am. One thing for sure is that everyone invests differently. My perspective is unique based on what I learned from different people and ultimately making it my own. Disclaimer, I'm not an investment professional. I'm sharing this information in hopes that it could give you one more perspective that you can use to build your own investment strategy. So, two parts in this video. First, the mindset and the key factors of investing. Second, my asset allocation, including stocks, hedge funds, real estate, syndication, and all. Starting with the mindset of investing. Investing is the ultimate escalator to wealth. At 7% return per year, you can double your money every 10 years. We all want our money to grow and multiply. A real investor invests in something that creates value and believe that it will ultimately generate wealth. Basically, money follows value and is not created from thin air. On the other side, we have speculators who only want their money to go up in value. They are short sighted and not really concerned about the value creation. Now, both sides can make money, but it's important to know the difference between the two. And I'm purely focusing on being an investor. Let's talk about value. You want to invest in something that creates value to others, like helping people save money. Companies like Walmart and Amazon try to give their customer the lowest price possible. There are businesses that help other business make money, like Google Search, bringing in new leads, or Square, simplifying point of sale. Could be a business that gives unique experience, like the Hyatt Hotels. I'm a big fan of their free breakfast and comfortable rooms. It could be a company that creates need-based products like food, real estate, oil and gas, and utility companies. It could be a tech company like Apple creating iPhones that let us take better pictures, or AMD making faster chips that allows us to have a better gaming experience. There are many other values, but the most important is to understand how the investment creates value for their customers. Without actual value, it's hard to think why the investment is worth anything at all. So to create value, business need time. Think about Coca-Cola. If they sell 100 bottles in a day, they will make 100 people happy. And that's the value creation. If they sell it for a year, they make a lot more people happy. That's why investors don't make money right away. Companies need time to create massive amount of value and in return increases wealth. So what can you invest in? The most common is to own a stock where you own a piece of the company, and if the company have a product that brings enormous value, your money will grow. You can also invest in bonds or notes, or basically buying a contract that is legally binding for the issuer to pay back a loan with interest. You can invest in real estate, your own home, rental properties, participate in a syndication, basically investing in a need-based product with limited supply. You can invest in people like yourself. You can buy books to improve your knowledge, pay for school, do your own business, and ultimately improving your skills and your value add to this world. It could be investing in other people. Maybe your friend is starting a restaurant and you believe in the project. Or it could be outsourcing your investment decision to an investment professional and betting on their knowledge. Ultimately, you can invest in anything that creates value. There are so many ways to invest, and at a high level, there are three categories of investing. Passive investing. It doesn't require as much research. Just invest and wait for the value to grow. This could be index funds, target date funds, robo advisors, basically investing where we have a strong historical data on value creation and a well diversified and contained risk. We should expect a return of 5 to 10% in this category. Next is semi passive investing, and this is one where there is a decent amount of research needed before investing and not so much work once the investment is made. It could be investing in real estate where there is a lot of work to determine the best location, the maximum bid price, the quality of the property, and so forth. It could be letting someone else manage your money, and there's a lot of due diligence to make sure that the person has the knowledge and your best interests in mind. With more effort required to invest, the estimated return should be higher, like 10 to 20% in this category. Next, we have active investing, and this is where there's work to be done before the investment and during the investment. It could be your own business or flipping houses, where there are a lot of preparation before jumping in and making it work. With so much effort and money, The return expectation should be above 20%, and anything lower is probably not worth your time. The point here is the more effort you put in, the more money you should expect to gain. Otherwise, there are default investment that can give a pretty good rate of return without doing so much work. Taking risks. There are always risks to investing, and I used to be afraid of losing money. For me to get comfortable, I have to believe in the value add and if the investment will exist in the next 20 years. Over decades, short term fluctuation does not matter, and the risk becomes lower if we have a long term perspective. Investment in the S&P 500, for example, lost up to 50% of their value in 2008 crash. At the same time, you might not make any money for over a decade. But over time, it corrects itself and still give a decent return on average because the business still continues to provide value. It's much easier to think in a 20-year time horizon than guessing what might happen in the next month or the next year. Also, when we think about risk, we have to look at what happens if we don't invest. Inflation reduces our buying power and ultimately loses value when we do nothing. This brings us to the most important factor of investing, which is asset allocation. Asset allocation is figuring out where you should put your money and how to diversify. Diversification reduces risk but also reduces potential. The best investment is investing in what you know and believe in the value add and have the most control. Usually, this is betting on yourself or your own business where you can invest up to 80% of your wealth. You might see super high net worth individuals in Forbes who have most of their assets in one or a few business. There's no need to diversify if you know what you're doing. Over time, you might max out betting on what you know or what you know just doesn't give as much expected return as you hope. This happened to me when I put so much money in Lending Club loans back in the days doing massive amount of data-driven research, and in the end, I only got a 6% return, which is lower than the passive investing in the S&P 500 index. That's when we need to diversify. Diversification reduces risk and allows investors to invest in things with more uncertainty. When you invest in a public company, for example, there are many unknown factors, like the macroeconomy. Will it help or make it difficult for the company? What are they going to do next? Investor will not have the full story unless you're in management. And even if the company tried really hard on the product, some things just don't work out no matter what the effort. There are so many variables in play, and the maximum we should put in these assets should be a lot smaller. It could be up to 20% in one company we truly understand, or up to 5% for a speculative investment. An easy method to invest is to invest in what you use personally. I eat at Chipotle on a weekly basis. Well, I buy some Chipotle stock. I love going to a Hyatt hotel, so I have some Hyatt stock. I think Teslas are the future, and I use their cars and solar, so I have some Tesla stock. If you own shares of the company you love, it's like every time you purchase, a small percentage go to their bottom line and eventually add value to your holdings. It's a frugal way of investing and buying your own product. An even simpler way to diversify is to use index funds, where you can invest in a sector, a country, or a set of companies without doing much research at all. And it's a very easy way to passively invest. Next, let's talk about tax efficiency. The biggest cost of investing are taxes. We need to reduce tax as much as possible. The simplest way is to max out funding to a tax-sheltered account and invest using account types like 401ks, IRAs, health savings account, and yes, you can invest your health saving account money. Personally, 70% of my net worth is in a tax shelter account, and that's fine. I don't need to touch it for a long time, and I will keep maxing it out. Once you max out the tax shelter account, you can invest in a regular account. Make sure to hold your investment for at least 1 year for the long-term capital gains tax, which is typically cheaper than the short-term capital gains tax, also known as your ordinary income. There are other strategies to avoid tax for different type of investment that a tax expert can help you with, but in general, the basic tax shelter accounts are good enough for most people. Now let's talk about market timing. The best time to invest is sooner than later. Time is your friend. Markets will go up and down on a daily basis, and to try to buy low and sell high is very difficult. I'd consider market timing to be active investing, and it takes an enormous amount of research to predict the markets and to separate luck from understanding. Yes, some people have done it well. Just read the Market Wizard series, but at the end of the day, they are very rare and points to the tip of the iceberg. Now, most people should not time the market and should invest when they can. If you haven't been investing for a while and worry about market timing, one way to invest is to consistently put money in every week or every month. There's no right or wrong answer. Bet on the long term value creation and it will work out on average. So, those are the basic concepts of investing. Now, I'm going to share how I'm investing my money. I'm in my early 30s and I plan to continue to work for many more decades, starting with the US equity index funds. This is a passive investment with a proven track record of yielding 7 to 10% per year on average, with drawdowns up to 50%. Most of my investment is using the Fidelity's S&P 500 fund because it has the lowest fee. But even using the SPY ETF, the fee is not material. Basically, this investment is investing in the biggest US companies and betting on the success of America. I look at this as a default investment allocation when I have nothing else to invest in. Currently, I have $76,000 invested in US equity index funds, including my health savings account. Next, I have international funds. This is a passive investment similar to the US equity fund, but investing outside the US. In the last decade, international fund didn't perform well, but we will see if we get a mean reversion in the next 10 years. I have roughly $26,000 here, and most of it is using my 401k, where I invest 100% of my 401k to an international fund. Next, I have the Robo Advisor Wealthfront. This is an automated passive investment, and I'm curious what allocation they put me in. The portfolio is automatically diversified with allocation in US equities, foreign markets, and bonds. I have around $28,000 in this platform. In these passive investment, I'd be happy to see 5 to 10% return per year. Next, I have individual stocks. These are brands that I personally use like Hyatt Hotels, Tesla, Apple, Chipotle, and some companies that I like. The best thing about investing today is you can split your money into as many companies as you want without paying a commission and can even buy fractional shares. I have a total of 12 companies and roughly $34,000 allocated. I would love to put more money into this segment over time. Next, I invest in a hedge fund called Paradox Investment Partners. I would label this as a semi passive investment where I spent many hours trying to get comfortable with the fund strategy before I invested any money. The fund manager is someone I knew for over a decade who worked for a few different hedge funds and recently started his own. From my end, this is investing in a person and his abilities to outperform the market. It's a tough job, but the incentives are aligned with most of the manager's net worth invested in the fund. The fund invests in individual equities with portfolio hedge made against various index. I expect this investment to outperform the S&P 500 index when the market is volatile. Currently, I have roughly $186,000 invested. Next, I have real estate syndication. This is another semi passive investment. I wanted to invest in real estate and figured this is an excellent way to get exposure. Real estate syndication is pulling money to a real estate operator and they will build, renovate, rent, and sell the building depending on the project. I invested in two deals. One is a large diversified fund investing in new single family housing in the Sunbelt states to turn into rental properties, and the other is building an apartment complex from an empty lot. Usually, these deals have a lockup period between 3 to 7 years, so not much liquidity. Now, these real estate syndication deals are not public. I receive access because my friend knows the operator. Outside of this, there are platforms like Fundrise that allow users to invest in real estate syndication. In general, these deals are more common than people think because real estate takes a lot of funding to execute and every deal is different. So it's still a fragmented market. Usually, you do have to be an accredited investor to participate, and it's a self-certification, meaning you just check the box in a questionnaire. In total, I have $85,000 in these deals and I expect a return of 10 to 20% per year. I also don't expect to get my money back until 3 to 7 years from today. Next, I have a corporate note. So I had a liquidation event from my employer and ultimately received a corporate note currently valued at $500,000. There were opportunities to diversify my holdings over many years, but I never did. I believe in the company and made a big return. This is one example where we do not need to diversify if we have good information and knowledge about the business. Right now, I can't do anything to it other than wait for the payments over time, and when I get it, I will reinvest the money elsewhere. Next, I have cash, savings, and I bonds. I wouldn't consider this an investment, but it's part of my portfolio allocation. I don't particularly like this allocation because of inflation. It's a good safety net in case something happens in life or a new opportunity arises. Earlier this year, I was considering buying a property, but I canceled because it's a hot seller's market right now. Now I'm trying to figure out where I should invest this money or just move it to index funds. Right now, I have it in my brokerage account, checking, savings, and I bonds with a total of roughly $117,000. Next, I have an investment in my parents' house. I help pay for the mortgage and build equity over time. When buying real estate, the most important thing is to have leverage, meaning you have a mortgage attached to the property and never pay it off. Why? Because real estate appreciation without leverage likely underperform other asset class. Just looking at the National Home Price Index, if you bought at the lows in February 2012 at 134 and sold on March 2021 at 243, you would have made an 85% return. Sounds good, but investing in the S&P 500 would yield roughly a 220% return plus dividends. It's not apples to apples either. Buying real estate have a high transaction cost and it's not diversified. Total equity wise, I probably accumulated roughly $100,000 in equity so far for this house, but I'm not really counting. So those are my asset allocation. Looking at it from a high level, this is the distribution by category. Overall, I'm generally happy with my allocation. I am concerned about my cash allocation and hope to invest it somewhere. In terms of account types, 70% of my allocation is in a tax sheltered account like traditional IRA, Roth IRA, and health savings account. The remaining is in a regular account and some in real estate plus syndication that have little to no liquidity for many years. So that's my current asset allocation. This will definitely change over time based on new opportunities and optimization. So to conclude, investing is the easiest way to build wealth. An investor invests in things that generate actual value for the long term. Being an investor, there are risks of losing money, but these risks outweigh the risk of not investing at all. The best investment is investing in what we know and diversify afterward. That's why everyone will have a different investment strategy and allocation. I hope my personal example can help you build your own investing strategy. If you made it this far, thank you so much for watching. Let me know if you have any comments, and you can help my channel by sharing this video to someone who needs to invest. I'll see you next time.